right, there we go. Thank you everyone for joining us today. My name is Virginia Wu. I'm one of the advisors at the firm. Just to let everyone know, we are going to be recording this. So keep that in mind if we're asking questions or coming in front of the camera here. I'm here to introduce our presenters today. We have two people that I'm sure are very familiar to a lot of you, but starting off, we have Karl Frank. Karl is a partner and the president of A&I Wealth Management. He is focused on helping individuals and families grow and protect their investments and choose how they'd like to be taxed. Karl is an active participant in the Denver community and a leader in the space. He is involved with numerous nonprofit organizations and has served as an ambassador to the Certified Financial Planner Board, as well as previously as a president of the Financial Planner Association of Colorado. Our second presenter here is Chad Harmon. He is also a partner at A&I Wealth Management and has been in the industry for almost 2 decades now at this point. Through various roles, Chad has really focused on helping clients maintain and build a sustainable plan for retirement income. Chad has been featured in 5280 magazine, as well as in the Wall Street Journal's 2015 list of wealth managers you should know. I want to thank both of them for taking the time to share with us today. As an advisor here, I really appreciate getting to hear directly from leadership about the market and their feelings on the current climate. So thank you very much for taking the time, and I'm going to hand it over.
Thanks, Virginia. I am so nervous about today's presentation. Like, you have no idea. So we get everything through our compliance department, and that takes a couple of weeks. And then we get the end of Q2 data from our investment research team, and that takes a couple of weeks. So here we are a month later, and almost everything Chad and I are going to present to you has changed. So it's really a good change. Like, it's mostly changed for the better, but I'm terrified to present to you what we're talking about because it looks a whole lot better than what we're going to talk about today. But that's also part of the reason why you have us and why we have partners to help us as well, because we get emotional about the market and we get emotional about the economy, we get emotional about politics, we get emotional about all sorts of things. And if we act on those emotions, it's often very expensive. So we're not going to act on the news that is good today. But we are going to share with you some of those updates. We are going to share with you all of our research and all of our forecasts from our chief economic research partner, IM Global Partner. And then we're going to give you a little bit of insight from our other research partner, Athena Invest. And I think you're going to really enjoy it. Make sure to ask questions. All of you who are online, make sure to use the chat. Virginia will be moderating that in the end. I think Chad and I figure we're probably about a half hour from about now. So maybe we're a little over a half hour total for everybody here. Here's our agenda. We're going to talk about the market in review and the economy. We're going to talk about interest rates, inflation, the chance of a recession. That sounds really uplifting, but it is actually going to be uplifting. And then we're going to talk about the investment outlook. And I'm going to talk about bonds and equities, international equities, and where we see opportunities today. So Chad's going to lead us off. He's going to hand it off to me when we're ready. And without further ado, here you go, Chad.
Thanks, Karl. Well, I'm just as nervous as Karl is for today's presentation, but I'm excited because we put on these educational events all the time on a wide variety of topics. And ultimately, what today's content is about is what we're here for, our core competency of taking a look at what's going on around the world and trying to help our clients position themselves to be successful no matter what the world throws at us. And so I'm going to go ahead and dive in. And I think to understand where the markets are going, it's helpful to understand where we've been. And up on the screen behind me, you're going to see some performance information covering a wide range of asset classes. The column that is represented by the navy color is going to show second quarter outcomes. The yellow column is going to show your year-to-date figures. And so across the board, global equities have rallied tremendously in 2023, led by large mega cap companies heavily focused around technology and specifically artificial intelligence, which I'm sure you've seen in the news quite a bit. In second quarter alone, the S&P 500 was up 8.7%. The majority of that came in June, where the S&P was up over 6.5% for the month of June alone. Year to date, we're sitting at 16.9% for the S&P, which we consider the core benchmark on how the U.S. stock market is doing. Across the pond and around the rest of the world, international equities have done well. They also had a strong June. Developed markets were up 4.6% in the month of June, bringing their quarterly returns to a positive 3% and their annual rate to almost 12% halfway through the year, which I think we can all agree are great figures. Emerging markets also rallied in June, bringing their quarterly return into positive territory and their year-to-date return up to a little over 5%. As we look at assets outside of the stock market, we'll move to fixed income. We know that the Fed's been raising rates. A lot of us saw last year a very unusual environment where the equity markets were struggling, and normally we'd expect bonds or our fixed income to be our life preserver. And due to the Fed's aggressive rate hikes, we saw the bond market struggle. And the good news is they're recovering. And so although investment grade bonds had a negative return through second quarter, year to date, they're still up over 2%. So if we multiply that by 2, a 4% rate on your conservative bond investments would be a pretty good year historically. Higher risk assets and things like high yield bonds have been leading the way in fixed income. They're up nearly 5.5% halfway through the year. And so although the fixed income markets were beaten up a year ago, we're starting to see some support and really see these values rebound, which is great. Lastly, I'm going to touch on kind of an alternative asset class and managed futures. And the reason we put that on the chart is because it is a strategy that we utilize inside the majority of our clients' portfolios. We call Simba. And last year was an interesting year because Simba did exactly what we wanted it to do, was really kind of help things stay afloat when nothing else is cooperating. So as stocks were getting beaten up and fixed income was getting beaten up, managed futures were the only asset class on the screen with a positive return in 2022. And although they hit some headwinds in first quarter of last year, primarily due to the SVB banking crisis, they rallied back tremendously in second quarter and were up over 8% through second quarter, bringing them back into positive territory year to date. So all in all, I think if this was something we saw year over year, we'd all be pretty pleased. So it's not all doom and gloom here today. We got to focus on what's working, and a lot is working right now. So I mentioned the S&P 500 has really been driving the way, and I want to spend this slide talking about why the S&P is actually going up. And right now, the S&P 500 is the narrowest market in recorded history. What I mean by that is the smallest number of stocks are actually beating the entire benchmark. Currently, only 1 out of 4 stocks in the S&P 500 is beating the overall market. Okay? Historically, that number is close to 50%. And so the returns are concentrated, and they're concentrated at a rate we haven't seen before, specifically in 7 very large technology-based companies you might have heard of: Apple, Amazon, Google, Meta, Microsoft, NVIDIA, and Tesla. Okay, and the more money and the more allocation you've had in these companies over the last couple of years, you've seen a tremendous run. Okay, however, with concentration comes risk, and that's something that we need to address today. So the S&P 500, historically considered very diversified, really is being driven by one sector, which is the technology sector. In fact, those 7 companies I named make up 108% of the return of the U.S. stock market this year. That means if you took those 7 companies out of the equation, the combined return for the other 493 would be negative. Okay, so we showed some really strong performance numbers, but it's important to understand what's driving those markets. IM Global Partners is our primary research arm, formerly Littman Gregory, which is a name you're probably familiar with. And their base case, or their crystal ball, if you will, is that the most likely outcome we see over the next 12 months is going to be the U.S. entering into a recession. Now, a recession can be a scary term. I'm going to throw out the base case for the recession and then talk about kind of the silver lining and what we're seeing today that we should feel positive about. So the reason IMGP is saying that a recession is imminent is because we still have relatively high inflation. We still have the Fed continuing to raise rates, although they recently hit the pause button. Okay, we see credit very tight. Okay, there's not a lot of lending going on. As rates go up, it's less advantageous to go out and take a large loan. Scenario where I think we should feel a little bit better is that we're seeing really strong numbers, and this is what Karl was hinting on earlier, is that the headlines this morning, last week, and the week before have started to show really strong growth in labor numbers, wage growth. Those both support consumer spending. Okay, we're flushed with cash. I think COVID over the last couple of years was tough for everybody. But one thing I thought was fascinating is that the COVID crisis was the first crisis in history we've seen as a country where discretionary spending actually increased. So our savings accounts, our bank reserves should be feeling more robust than they have been historically. Banks are hoarding cash on the sidelines, which promotes future investment and future growth. We also don't see any major systemic imbalance in the financial markets or the economy like we saw back in 2008, which is great. So although we could enter into recessionary territory, I think we have a lot of things we can focus on in the positive. On the screen here, what we're looking at is a graph of the U.S. recession probability indicator. Okay, we can take a look and see that recently the chance of recession heading into March of 2022 was pretty low. When the Federal Reserve started to raise interest rates and our yield curve became inverted, it's the primary factor that's driving this recessionary statistical calculator. And right now, we give a 67% chance of the U.S. going into a recession. Okay? When the yield curve became inverted, these numbers start to spike. And when the yield curve stayed inverted for an extended period of time, that's where you see things really start to escalate. I want to spend a minute focusing on a leading economic indicator. What is that? So a leading economic indicator really is just a measurable set of data that is used to help us forecast where the economy could be heading moving forward. The most common ones we hear about out there are the yield curve, which I've touched on briefly, and Karl will go into in depth. New building permits would be a great thing to look at. What's going on with the U.S. stock market or the S&P 500? New manufacturing orders. Okay, and new durable goods orders. Another 4 or 5 are listed here on the screen, and I know that this is a lot to look at, but what this rainbow is trying to tell us is that from the right side of the screen, it is showing the progression of these leading indicators year over year, going back a decade. The 4 columns on the left represent the last 4 quarters. Okay, represent the last 2 of 2022 and the first half of this year. You see that it's not all red. It's not all doom and gloom. Although many of these, such as consumer sentiment, the yield curve inversion, are in the red category, red meaning bad, green meaning we should feel warm and fuzzy, okay? It's not all doom and gloom. And I wanted to put this slide up specifically to make a point that I think we need to take everything we hear from our friends and on the news and what we read or look up on our iPhones these days with a grain of salt, because I saw a headline a few weeks ago and it said, housing boom is inevitable. We've seen housing starts decline 4 quarters in a row. And I had recently looked at this chart and I sat and paused and I pulled it up and I said, well, wait a second. It is true that housing starts have declined 4 quarters in a row. But we need to add some context to that. And I looked at the amount of housing starts, which is a good thing when we're building and investing. Okay. And I compared where we're at today to where we were at 10 years ago, okay, which was post 2008 when we saw our economy absolutely booming. And today we are building twice as many houses as we were a decade ago. So yes, it has retracted over the last 4 quarters, but historically speaking, we're investing in building an infrastructure more than we ever have throughout history. So I think that's a helpful guide just to show that it's always going to be a variety of factors. Some are going to be working for us, some are going to be working against us. Now I'm going to touch on inflation. So inflation has been in the news a lot. I think we all felt it as we started to see core inflation numbers peaking at 8, nearly 9% recently. The good news is that inflation is retracting. Currently, headline CPI, which includes energy and food. I'm sure we've all felt the pain when we're going to King Soopers or we're filling up our car with gas. We've noticed things are quite a bit more expensive. But core inflation has dropped from nearly 9% all the way down to 4.1% at the end of May. That's a good thing. And we believe that that number is nearly guaranteed to continue to drop over the coming months because of base effects, which is a measurement of prices today compared to a year ago. And as we look at the numbers that are affecting the inflation calculation today, those expensive months, 12 months ago, 11 months ago, 10 months ago, will start to fall off. And the lower inflation or cheaper pricing today is going to start to be added into that calculation. And so we're expecting that 4.1 number to continue to go down. As we look at core inflation, which excludes food and energy, Federal Reserve hopes to keep that number around 2%. It's remained stubbornly high. It's a little over 5% today. And that's something that the Fed is keeping a very close eye on, because as the Fed had gone through 10 consecutive interest rate hikes, totaling 500 basis points or 5%. And I want us to think about that. A 5% increase since March of 2022 in interest rates means that if I am a prospective home buyer and I want to go out and take a $500,000 mortgage out to buy a new property in March of 2022, it would cost me about $2,000 a month. After the recent Fed rate hikes, that same mortgage that cost me $2,000 a little over a year ago would cost about $3,650 today. A huge difference. And so we need to get those numbers down. And as the Fed did hit pause in June in their most recent meeting, all signs lead to potential rate hikes to close out the year 2023. I think originally a lot of our research partners and the pundits out there were expecting the Fed to actually potentially lower rates towards the end of the year. It does look like that timeline has been kicked down the road a little bit. I'm going to now hand things over to Karl. He's going to touch on the yield curve and get into a little more detail here. So thank you guys very much.
Good job, Chad. I don't know about you, but if you look at a lot of charts, they can get really confusing. So what I thought I'd do is slow it down. And if this bores you, enjoy your food. But I'm going to slow it down because I know that when I watch an economist talk and he spouts a bunch of numbers and sees a bunch of lines on a screen, it can really be overwhelming really quickly. And we hear this phrase, the yield curve, all the time. And the yield curve is really lining up on the bottom time and on the left-hand axis, the rate. And so if you buy a bond and you get your money back a month from now, you're going to get a higher rate of return. That's what this orange or yellow or the whatever color line on the bottom is. I'm not good at colors. That shows you that you're actually getting a higher rate of return and you get all your money back in a month than if you wait all the way to the left-hand side 30 years for the same money. So that doesn't make any sense. Why would you give up your money for 30 years if you can get a higher rate of return and only have to wait a month? And that's what they're talking about when they say the yield curve is inverted, because this is not normal. Usually, if you're going to get a CD or a bond or something and get all your money back in a really short period of time, say 6 months, you're going to get a much lower rate of return than you would if you would give the bank or the bond lender 4 years or 5 years to give you all your principal back. That makes sense, doesn't it? You're having to give up your money for a longer period of time. So in compensation, they're going to pay you more. That's a normal yield curve. That's called a steepening yield curve. And that's not the world we're living in now. And it's not the world we've been living in for a while. You can see this chart is showing 3 different lines. The current one, and this current is as of June. It hasn't gotten better since June. The second line is about 3 months ago, and the orange line is a year ago. So you can see what's happened over the past year is that it went from almost normal, where the line was kind of flat, which still isn't normal, right? It should go from bottom left, where the shortest period of time pays you the least and the longest period of time pays you the most, to not good 3 months ago, to really not good today. And so the worsening yield curve is a problem for the economy. Why would you ever wait 30 years to get your money? Why would they sell the bonds today and raise the rates today? And that's because all these investors out there are thinking, oh, we're going to have a recession. We're going to have a recession. The Fed's going to be forced to lower the interest rate. And so we think, and it looks like it thinks even pretty quickly, like less than a year or two, or maybe definitely within 5 years, rates are going to be lower than they are today. And so this is the market's way of predicting what the Federal Reserve is going to do. And it's been very reliable. It's the leading thing that Chad was talking about here. So an inverted yield curve is really just saying that. It's saying this isn't normal. It's saying I get a better rate of return on a shorter period of time than I can if I wait a long period of time. But that's also pretty good for investors. As I'm going to show you here in a minute, bonds are paying really high rates of return right now. This chart's got a lot of data on it, and that's one of the main reasons why I wanted to slow it down. This is showing the history. This is showing another reason why I Am Global Partners is fairly confident that we're going to have a recession within the next 12 months. Every row that you see here is a past period of time. It's a period of time. The first column is going to show you when the Fed started raising rates, and then the second column is going to show you when the Fed stopped raising rates. And then what it's going to show you at the very last column is whether we entered a recession or not. The third column is saying this is the rate that it was, and this is the rate it was at the end, so at the beginning and the end. And then the fourth column is what Chad was talking about with core PCE, personal consumption expenditures. It's the one that excludes food and energy. And it says, okay, we're going to look at how bad inflation is and how bad the interest rates are. And then the fifth column is going to show you the difference. And what the bottom line is that when the Fed raises rates, and it's done this 13 times since World War II, all but 3 of the times we've had a recession that follows that. That the Fed raises rates until we get into recession, and then all of a sudden they have to reverse because, oh no, we're in a recession. And so they lower rates. And so you add the yield curve, which the market is predicting the Fed's going to lower rates here pretty soon because there's going to be a recession. And you add this, the history of when the Fed raises rates. You say, oh my gosh, it looks like we got a pretty good chance of recession. And so that's I&I Global Partners' problem. That's really not our problem. Our problem is just, are we making money? And it's like Chad started out with, we're making money. Our investments are doing really well. We want to be in the place ahead of that. And that's one of I&I Global Partners' job, is to help us figure out what's next. Where do we want to be next? It's not our job. Well, right now, like Chad was talking about, bonds are doing great too. Here's every set of columns you see here is one of the investments that you might have in your portfolio. These are our typical bond portfolios that you see here. And the tallest bar that you see here on the right, the blue one, is the current yield that you're getting on the bonds. They're huge. The next 2 smaller bars, the gray one and the yellow one, that's what they were a year ago and 2 years ago. So you can see the yields on our bonds. Our bonds are now paying you a whole lot more. The one on the left pays 4.5. The one on the right pays a 7% per year yield. That's big numbers, right? So if you can be comfortable with bonds paying that kind of interest rate, you can be comfortable investing. Makes sense, doesn't it? Right? That's a pretty good yield. And it's a whole lot more than it was, right? Not very long ago, this was paying 2s. This was paying 2s. The one on the left from a big company everybody's heard of paid only a 1, right? And now all of a sudden it's 4.5. So that's a pretty good change. So investors today are getting paid a lot more for owning a bond portfolio. That's good. That's good news. The next set of good news, which might not be good news, is that the S&P 500 is doing really well. Like Chad was saying, almost all of the returns of the S&P 500 as a whole are coming from a handful of big technology companies, right? That's not good news for investors, but it's been good to be an investor in things like the S&P 500, in a large cap US company. What this chart is showing is that generally speaking, the stock market follows the earnings of the company. If you're going to invest in a company and the earnings go up, then likely the stock price will go up in that company too. And the more that you pay, the higher the price that you pay for a unit of earnings, the higher what they call the PE, price over earnings ratio. And the higher that number is, the more risky it is, because that's a whole lot of money you're paying to get a little bit of return, right? Kind of like the bonds, if you can get a 7% yield, it feels like you're getting a lot more yield, right? You're getting a lot more income. Well, the same thing with bonds or with equities. This is showing that we're still really high, that earnings are still really high. And this ratio that it's showing, and this is going back to 1955, so it's a really old chart. And it's older, I think, than Ben Bernanke, or maybe not Bernanke, but a lot of the people in the Fed. Anyway, that it usually happens that when you enter a recession, earnings come down. That kind of makes sense, right? That the stock prices would follow, their earnings would decline, and oh my goodness, that was not a good thing. Well, that hasn't happened yet. We haven't had earnings decline nearly as much as what I&I Global Partners would think if we're going to enter a recession. So now you got to think to yourself, uh-oh, if prices haven't come down, what's going to happen next? Well, eventually, if they're right, there will be a recession, prices will come down. Where do we want to be? Well, you probably don't want to be in those same 7 companies that have driven 100% of the returns of the market this year. You probably want to be in other companies whose prices haven't gone up. And one of the places that they like is outside the US, So this chart, again, is showing back in time. This is the 2006. This is back in time to a very young child, right? A child who still lives at home. So it's not the longest chart, but it's showing a good history that it used to be not very long ago, that if you looked at the US versus big countries in the world versus emerging countries in the world, all these lines more or less went up and down together, that they all moved pretty closely together. That if you bought a company that was based in the US, it would give you a certain amount of earnings. You are willing to pay about the same amount per unit of earnings as you would if you bought that company that was in another country. And that would be pretty normal, right? It bounced up and down, bounced up and down. But then look what's happened recently. This dark blue line is the US. The US is getting really, really expensive. And so that's becoming more and more risky. And if you are an investor, like say a Warren Buffett investor, a person who wants to buy companies that are paying you good amounts and not pay a whole lot for them, if you are a Walmart shopper and you can get the same thing for 88 cents that you could get for $1.50 somewhere else, then you like this situation because you're going to buy these companies down here that are the same quality, paying you the same earnings, and pay a lot lower price to get them. And so I&I Global Partners is suggesting, and we are, for the vast majority of our portfolios, investing in a way that we're going to have a little bit more overseas than we do normally, because it's just on sale, right? It's like buying a sweater that it's the same quality at this store as it is at that company, at that store. But at this store, which is in a bad neighborhood because it's close to Ukraine or Russia or whatever it is that's making the world a little bit nervous, you can get it a lot lower price. And so that's where we're going to go. And that's where we have been going for a little while. And very recently, that's been a very prudent decision. And I&I Global Partners is not making a short-term forecast, but they are saying over the next 5 years, it just makes sense, right? It just makes sense that you're going to put your money in a little bit better opportunity. And so for a large number of portfolios, we're doing that. Now, the right way to invest is to not bet everything on a single strategy, okay? And so we're going to diversify by strategy. And all of the strategies that we're talking about here today are the economy. And so we're going to take that with a grain of salt, right? We're not going to bet all of the everything on any sort of country in the world or any company in the world. And one of the reasons why it is on the screen. Again, this is a chart. And this one goes back to 1987. So this is just a little bit older than, I don't know, Taylor Swift. And during Taylor Swift's lifetime, the dollar has actually gone up and down in value. Over the long period of time, over my period of time, which is just over half a century, the dollar is actually declining in value. Right? And that's what we often hear on the news. We hear about the dollar declining, dollar declining, dollar declining. But that's not true in Taylor's lifetime. And it's not true actually in recent history. Every time you see both these lines going up, the dollar is increasing in value. And so from that period of time in the 90s to the end of the 90s, the dollar index relative to all the other dollars in the world, all the other currencies in the world, rose in value. And so did, by the way, the S&P 500. So as the dollar rises, so does the U.S. company. Then there was a period of time where they both declined. And that makes kind of sense if you think about it. As the dollar is declining, U.S. companies' stock relative to international companies are becoming less appealing. And more recently, it's been growing again. And so what is the bet here? That eventually this is going to stop, that eventually the dollar will stop rising. It's in this long-term secular downtrend. It kind of makes sense. We continue to raise debt and all these other things compared to other countries in the world. And so it's going to reverse. And in the meantime, international is going to suffer until the dollar does reverse. Right now, as the dollar is strengthening relative to all the other currencies, this is great for U.S. travelers. Go overseas. Everything's on sale. I guess Japan is on sale over the past 2 weeks, right? Go and travel, be worldly because your dollar is worth more, right? But eventually this trend during Taylor's lifetime is that things will come back to normal. Things will decline over over the near future. So that could be 3 years, 5 years, 10 years. There's no way to really predict it exactly. Nobody has a crystal ball. In fact, Chad talked about, the crystal ball. Ours is pretty foggy. And the tea leaves are really muddy. I mean, we really don't know over the short period of time. But common sense, taking 2 steps back, says, oh, yeah, right, that kind of makes sense. So if the dollar gets back to a more normal range, then all these places outside the U.S. become a lot more appealing. And so that's like putting a little afterburner in your car. You can go a little bit faster if you've got your European car or your dollar. Not dollar-denominated investment. All right, so that's the Lippman Gregory opinion. The I&I Global Partners opinion is a little bit negative, right? It's also a little bit realistic, and there's a solution for it. So even if the U.S. economy enters recession, it's not a good idea to yank your money out. You can never time it exactly anyway. What we can do is prepare and put our money where we think we've got really good opportunities. Makes sense, doesn't it? Our other research partner is Athena Invest. And Athena divides all the information we just looked at into 4 big boxes: the left, the middle, and the right. And we'll just start on the right, which is the technical, which just says, hey, the market's been going up, go figure, right? So it must be good. It must be good. That's the easiest to understand. It's called technical analysis, and it's just saying the equity markets are going up. The second from the right is valuation, and that's what we were talking about, Chad and I both, that its valuations are super high for U.S. companies, right? People are willing to pay really high prices, more and more prices, for lower and lower earnings. I think Chad mentioned the top 7 companies. The craziest one is NVIDIA. NVIDIA is a company that used to make video game cards. And then that shifted because they were the only company that could make chips for cars. And now that shifted because everybody wants artificial intelligence. And NVIDIA makes parallel processors that do this a whole lot better than their competition. Well, they're not going to be the only company doing that forever, right? But their stock has increased 200% since January 1. And its price to earnings value is over 220 to 1. Now, the average, right, we're showing is about 20. This is, in other words, 11 times as risky as the rest of the market. People have just bought NVIDIA for crazy reasons. It's just continue going up and up and up. So maybe we don't want to overemphasize what's already done well. Maybe we want to be somewhere else. The one in the middle are the economic activities. This is what Chad was talking about, both services and manufacturing. And the one on the left is the unique one. And that's the one that's unique to Athena. And that's the one that made us, or made Athena, for a slice of our clients' portfolios, get more confident recently. And that is that Athena made a decision in what they call market rotation to be more in small cap than in cash. And so Athena is also predicting good news. So everything up here looks like a colorful rainbow like Chad was talking about. But by and large, it looks like we're coming into a transition point. And it could be that it goes one way or the other way. And the right way to invest is to diversify by strategy, because we don't ever know in advance who's going to be right. So that more or less concludes our prepared comments for today. Be a little humble, be a little diverse, be grateful that things are really good compared to last year, and also put the bad news into perspective, right? Nothing that's happened here, all of those, that big complicated chart I showed you with 13 rows, shows that, actually things rally back quickly after every single time. And for a 5% interest rate increase, that really did a good job of helping our bonds give us more return. And the bonds aren't subject to stock market volatility. All right, so that's our prepared presentation. We do have a couple of questions. If you're online at home, type it into the chat. And if you are here in the audience, just fire away.